Could you speak to the management team that's in place and any issues related to that?
I'm sorry, would you repeat the question, please?
Could you speak to the management team that's currently in place, their incentive packages, and any governance issues that you see?
If I understand the question, you're asking if we spoke to the management?
Could you describe the management team that's currently in place, that's leading the company?
Sure.
Have you identified any corporate governance issues in your review?
Sure. The management team currently in place is the first team since the founder relinquished control of the company. They are professional businessmen and women. They are not entrepreneurs. We don't see any glaring corporate governance issues. There was one issue with executives selling shares while the company was buying them back, but we investigated that further, and it was due to stipulations in their contract about when they had to and could not exercise shares. So at this point, we don't see any glaring corporate governance issues. Our communication with them has been extremely forthright, and we think they're a very competent management team.
Is Zebra paying a dividend? And with all that cash flow, what are they doing with it?
Well, Zebra currently does not pay a dividend. With their cash flow, this is one of the things that we wanted to investigate further. We feel that Zebra is not a very investor-friendly company per se. What they do is they distribute their free cash flows, and they distribute their cash back to their investors in the form of share repurchases. While this does give back some wealth to the shareholders, it also sort of reduces minority control. So as what we could recommend is that they should have a dividend policy. This would further increase long-term investing, which could be good for the company.
And to add to that, what they do with their cash flows, they've been financing organic as well as inorganic growth. So it's a zero-debt company, and we've investigated this extensively, the zero-debt capital structure of the company, and we found that because of those strong free cash flows, they're generally around $150 million a year, with the exception of 2008, where around $100 million. They've used that cash flow to finance inorganic growth as opposed to issuing debt to do so.
Can you tell me a little bit more about the risks that you see and how you've incorporated them into your valuation?
Sure. We've used a lower than perhaps reasonable growth rate, a terminal growth rate, to encompass all the risks that we've found. Our DCF model doesn't explicitly accept risk inputs into it. So in order to account for that, we've used a little bit more conservative growth rate. As we've said, nearly 60% of revenues come from overseas, and it's generally accepted that in a healthy economy, worldwide GDP growth, at least in the countries that Zebra operates in, is something greater than the 3% that we use as the perpetual growth rate.
In your vertical market focus, where you show the diversification among their client base in different industries, aerospace, healthcare, et cetera, where do you see the greatest one or two risks to Zebra meeting your price target in terms of what industries, if they weaken, would have the greatest negative impact on your forecast?
By far and away, it'd be manufacturing. That's certainly where they generate the most money, because they do offer extreme supply chain efficiencies to their clients. Manufacturers process the most widgets, if you will, through the supply chain. So a substitution product that could happen in manufacturing supply chain management would negatively affect them. However, their products are very expensive to implement, and they are cutting edge. They're a pioneer of technology. They have the broadest product line, and amongst all their competitors, invest the most in R&D. We don't see, we have no reason to believe that'll happen in our forecast period whatsoever, because the cost to replace a Zebra system is very high.
And just to add to that, in the thermal printing and passive RFID business, we see two major sources of business to Zebra. One would be supply chain management. For example, on an assembly line, you want to keep track of a product that's moving through the assembly line. Another example would be, for example, Walmart. They want to keep track of their warehouse inventory. Now, we have seen that Zebra's revenues tend to fluctuate with the business cycle during times such as several months ago, when there are negative figures perhaps in the manufacturing space. So especially in geographical locations where manufacturing is a big driver of GDP, there is some risk in the thermal printing business, but this is mitigated because they have a variety of industry leaders as their clients, and there are many very, very broad applications of their products.
Could you speak to how you modeled the decline of the thermal printing business, if you will, the cash cow, over the expected life of your DCF?
Sure. The growth rate that we use in a perpetuity stage is not necessarily a decline in the growth of thermal printing. We believe, as we touched on earlier, that thermal printing is actually midway in its late majority stage, which means that we feel most companies that would have adopted this technology already have, and we are only waiting on, say, 40% of the rest of the market to follow. At the same time, we do feel that the thermal printing unit, the management strategy behind it is to grow market share in places that are underserved. For example, on the latest earnings call that I listened into or read the transcript of, one of the underserved regions that Zebra felt they could get their hands into was government. Now, there have been a number of government contracts, both American and Chinese, that have required companies and their agencies to take control of their products through passive RFID thermal printing units. This is a big source of revenue going forward, and this has been stressed many times in the earnings calls by management. We feel this is a reasonable strategy going forward.
Can you talk a little bit about their capital expenditure plans? Again, with this use of the free cash flow they have.
Zebra Technology Corporation has already incorporated the ERP system into their operations, which means there will be higher operation efficiencies. And by reading their 10K, they are not foresee their capital structure will be higher in the next few years, which had already been reflected in our forecasted cash flow statement. It were our capex divided by sales ratio will remain stable in the next 5 years in our forecasting period, because they did a really good job in the past few years to keep to adopting their ERP system, which will be completed next year.
Why are they no longer segmenting the revenue?
We feel that the products that Zebra and its competitors offer, there are a number of private competitors that we touched on, Datamax, O'Neill, Printronix. They all operate in a similar space where there's kind of a thin line between thermal printing and passive RFID. They are at the moment complementary, but they could at some point erode profits into each other, being more of a substitute. Now, this is important that Zebra, this is part of the strategy to kind of conceal exactly how much research and development and how much manufacturing they want to put into each segment. Because if you look at the earnings statement, let's say up to 2010 when they did report them separately, any company that is competing with you can figure out, let's say, how many hundreds of millions of dollars you are putting into investing in a new plant in this industry or in the other. So we feel that this is a good idea. It's not necessarily for us to benefit from, to see that they are reported independently. It's not a big problem. I don't think they're trying to conceal everything, and they've been very honest and forthright with us in our conversations.
In your profitability analysis, you talked about a 5.5% top-line revenue growth being fueled mostly by emerging markets, which are the most volatile of all the markets out there, typical boom-bust scenario. Do you think your analysis is weighing too much on the success of emerging markets?
Well, I would say so, but I think we're backed historically. This is over 10 years' time, and we've seen historical data and how well they've actually managed to execute their plans. So I don't think that this is a boom-bust scenario per se. I also think that they're pretty aggressive with their emerging expansion. They have actually set up a new R&D facility in Guangzhou, China, and they explicitly want to expand in countries, specifically Brazil, India, Russia, and China.
Just to add, we didn't touch on in our presentation, but they sell their product through an extensive distribution network of value-added resellers. These value-added resellers are completely in tune with the local markets they serve, and it does act as an additional buffer from the boom-bust idea of an emerging market. Additionally, too, they make a considerable amount of revenue from supplies, which are repeat orders. And that's another once they have their product in place, they have a profit stream to generate outside of just the hardware. another way they're insulated from maybe the volatility of emerging markets.